afternoon, everyone. Hope everyone can hear me. We're joined by Bella today, who is the founder of Fundscape, which is a leading market research business based here in the UK. And they do end-to-end research around distribution, basically the dynamics of distribution, particularly trends and strategies around that. So we've got a lot to learn from Bella today. Bella, would you like to share your presentation?
Excellent. Well, good afternoon, everyone. I'm not sure how many of you were there for the first webinar I did back in November on the importance of distribution. Distribution is the bit I love about the industry. We can have brilliant funds, but at the end of the day, you need to be able to sell them to the right people. So today I want to kind of explore the practical steps you can take to improve your chances of winning business in the UK and Europe. And I'm going to give you a few specific good and bad examples. And we'll review, some of the fundamental mistakes I think that some people make when they're targeting the market. So I think that I'd like to make this session as interactive as possible. So if you've got any questions, please do let me know. So I'm going to get started now, and then you can flag any questions and shout. So I think the first thing is that I'm assuming that you're from all over the world, and that you're small and large fund managers of all sizes, and you've obviously got good performance, and that's how you probably see yourself. You've got great performance in your own market, you know your knitting, and you've decided that the time is right to expand into the European market. And it's easy to assume that it's all about performance, but the reality is that performance is just one bit of it, and you have to work much, much harder to raise your head above the parapet. So yes, you might be a big fish in your own pond, but that's not enough to attract attention. So while you might have fantastic performance and you stand out from, in your own market, professional fund selectors in the UK and Europe are likely to see you as yet another irritating little fish in a very crowded pond clamoring for attention. If you imagine that you're a fund selector or a distributor, a large distributor, you may have a dozen or more fund managers with excellent performance in front of you. So how do you differentiate yourself from the crowd? And the point is, it's not up to European allocators to spot you. It's up to you to jump out of the bowl. Performance is just a tiny bit of the equation. It's the other parts in the value chain that are going to make a difference. So if you do have questions, please, do raise your hands or use the chat, and hopefully Stuart is monitoring it and will be able to tell me.
I'm monitoring, don't worry.
Okay. Good. So I get calls from overseas fund managers on a regular basis, at least once a month, if not more. And they've got great funds and got great performance, and they often make the very same mistakes. And they say, we've got great performance, we don't understand why we've been coming to the UK or to Europe for the last 5 years, and we don't understand why we haven't got more than 50 million or 100 million. And generally, these are the mistakes that they make. They fly in every few months and do the rounds. They only have one sales guy covering Europe. Now, Europe is not one big country. Europe is a patchwork of 27 different countries, all with very different needs, very different local markets, different requirements in terms of materials. So you just cannot have one person covering all of Europe. The other big comment that I hear regularly from fund managers from overseas fund managers who want to come to the UK is we don't want to commit until we have assets. Well, unfortunately, that's not going to work. You need to make a commitment first and show distributors that you're making a commitment before you get assets. And again, that also applies to the second comment I hear, all the time. Oh, well, we'll invest in some local resource when we have some assets. Again, that needs to come first. It's a chicken and egg situation. What comes first? What comes first is the chicken. You've got to be ready. You absolutely have to have everything in place before you can do that. Another one that comes up all the time is, about launching new share classes. Oh, we don't want to do that yet, and it's expensive, and we don't want to do that until we've got commitment. Again, you have to be ready, because all of these things, all of these comments, if you're a distributor, a big distributor in the UK or in Europe, looking at, an overseas fund manager, they all smack of one thing: a lack of commitment phobes, right? And we all know what the problem with commitment phobes is. So, what they don't want is a fly by night. I'm here today, gone tomorrow, because I came in, I invested, I didn't get any money, I'm off again. That's not what they're looking for. They're looking for companies that are going to be around for a while. So, just to reinforce that point, how to do well in the UK and Europe is to be in it for the long haul. And that does mean that you have to be prepared to invest heavily upfront. So you've got to demonstrate commitment by putting the resources in place immediately. And you need to know your market and know your audience. So that does mean really taking the time to understand local needs, local market preferences, who the players are, who the distributors are, how your products could help and support them. All of those, you have to do your homework. And I think it's, if you see in the background of this picture, we've got kids in the background, and it's the one thing that we've all got children, or most of us have children, and the one thing that we always say to our children is make it easy for the examiner, right? When they're going into their exams and their schoolwork, doing their schoolwork, make it easy. Don't make the examiner have to really look for the points to give you. You've got to make it easy, and this is exactly the same strategy. Make it easy for the distributors. Make sure you've got all your eggs in one basket, all the chickens lined up, I'm mixing loads of metaphors here, but you do really have to do all your homework, have everything ready, and hope that you're going to win the business. But you do have to come to the UK and Europe with a long-term strategy, very much so. Don't expect to raise assets very quickly. You've got to be in it for at least 10 to 20 years. Hopefully that doesn't put you off too much. I want to give you a case study. I think this is the first one that I'm going to give you, and this is Vanguard. So pre-RDR, which was 1st of Jan 2013 when it was introduced, Vanguard had been in the UK, but was very much an institutional player. Mainly because obviously it's got a lot of passive funds, and it realized that it would struggle to sell its products in an intermediated market when, with a commission-led environment. Obviously that changed with RDR. Commissions were outlawed, and therefore this opened up the opportunity for Vanguard. And what it did though is it spent a long time planning its route into the market. Every fund was placed on platforms in the UK. It put in place a large infrastructure team to support advisors and consumers. It invested heavily in marketing events to get to know its target market and to get to know those financial advisors. And it produced very, very specific advisor materials showing how its funds could be used, how it could be used in different situations, how they could be used in model portfolios, etc. So this is a key example. And just to give you an idea, Vanguard went from nothing 10 years ago to now being the leading fund manager by assets and flows in the UK. Okay. If we look at sort of European and global distribution trends, a lot has happened in the last few years. Regulation and technology are really driving change. And concentrating, and that is driving consolidation, concentration, complexity, and compression. And that means a different response. You have to respond differently because of the concentration in large distributors. They are very demanding. They want to know exactly how your funds are going to work and how they're going to fit in with the rest of the palette of investments, with the rest of the portfolio. So these are big trends that are happening everywhere. So you have to take a very scientific and data-driven approach. So professionals, and by that I mean professional selectors have very high expectations. So the first thing you've got to have is the robust risk and governance procedures in place. That's really important. But they're also looking for what's going to make you stand out. So performance is your thing. You've got great performance, but you need to demonstrate that you can show the portfolio breakdown very easily so that they can link that into the rest of their investments. You need to focus on attribution analytics, and you need to focus on bespoke reporting, because that is what is going to be driving their selection. Again, it's coming back to the point about making it easy for the examiner, making it easy for them to give you points, making them easy for them to prefer you to other fund managers with similar investment performance. So I think this will help you, again, it helps you build deeper relationships. If you do these steps, the performance, the portfolio breakdown, the really extensive attribution analytics and bespoke reporting allows you to deepen your relationships with those distributors. And the last thing they're going to want as well is really good access to the actual fund managers. They like to look the fund managers in the white of the eyes. They want to understand, what's going to make them flinch, what's going to make, will they stick to their process regardless of the market cycle, regardless of what's happening. So again, these are all the factors that will really help you and support your business when you're out winning mandates. And just to sort of give you a bit of a view on this and why it's so important. Q1 22 was obviously a tough quarter for most fund managers, certainly in the UK and most certainly in Europe as well. And yet Fidelity Investments recorded its best sales in Q1 22, despite the outlook and despite the sluggish start of the year. And that's because it spent a lot of time doing exactly that. It's enhanced and improved its product materials. It's demonstrated how funds work in different scenarios and portfolios. And it's really invested heavily in portfolio breakdowns and attribution analytics. Those factors have really, really changed the relationship with distributors, the large distributors here in the UK, the big consolidator firms, who can really see that Fidelity is a strategic partner that they want to, Fidelity has demonstrated that it's a strategic partner that they want to work with. So if you're a fund manager that is approaching the UK or Europe for the very first time, and you may have lots and lots of funds in your stable, and it's tempting, isn't it, to come to the UK and sell everything and go, well, I've got this equity, I've got European, I've got US, I've got, and you want to demonstrate the breadth and depth of your product range. But we suggest that that's not a good idea. You need to build a name for yourself, and often it's better to build a name for yourself in a specific asset class or sector. And that way, that builds a presence and profile with distributors. You get a name for being, for example, good at fixed income or good at absolute return or whatever. And once you've established your presence with those distributors and wealth managers, you can then start to introduce other products. Okay. The second thing that we would say, a lot of people say, well, we can't build, we don't have the resource of the budget to build a big distribution team, that would just kill us. Again, we suggest that work very closely with third-party distributors around Europe. There's some really, really good firms, and they all know their local markets very well. They've got the contacts, they've got the relationships. So rather than trying to do it internally, outsource, outsource in specific countries. If you've got, if you're well known in the UK, then maybe do insource there. But if you want to expand into other markets quickly, then work with third-party distributors. The third point I want to make here is, get your materials written and reviewed by local people. Whatever you do, don't translate, and certainly don't translate. Don't use if you're translating into English, make sure it's written by someone whose mother tongue is English. I've seen far too many examples of things of poor translations, and which is shocking in our industry. The last point, again, I keep reinforcing this, but do your homework. Can you support their needs? The distributors in Europe are large universal bank distributors. They have a lot of power. They want to work with strategic partnerships, but they will be really, really demanding. Can you support that? And just to reinforce, this is a negative case study, and I want to talk about Lixor, which is an ETF provider, part of the Amundi Group. And here in the UK, they made several mistakes. They didn't want to invest. They thought they knew best. The French way was the right way. And of course, the French market is very, very different from the UK market. So again, that they failed to understand the fundamental difference between the UK and French market. But they had one guy to target the UK. Again, really didn't want to invest in a team of people to work with the different advice firms, platforms, etc. So this person just couldn't do the work it needed to do. The second mistake, or the third mistake, were the materials. The French love being, think they're very clever. Sorry, I'm married to a Frenchman, so I think I can say this. They're quite highbrow. They're proud of the knowledge and expertise that go into the funds, but the materials were far too highbrow and far too technical, and they failed to tailor them to the audience. So again, that was a mismatch. But the worst mistake was that they had the materials translated by French people into English. So they just weren't, although technically correct, they just didn't make sense. And when we reviewed them, we pointed that out. But again, it was very difficult because a lot of companies centralize things. It was very, very difficult for them to change that. So ultimately, Lixor didn't do well in the UK market and has disappeared. A few more do's. Again, I think it's important to really consider how your funds can complement different risk profile solutions, different models, and how they can work with different funds, asset classes, and etc., and add value. So, are you selling something that could be a component, a building block that is part of a broader portfolio? If yes, then how will that work in different scenarios? How will that work against different things? And maybe you've got some really clear ideas about how your fund can add value to a passive solution or a mainly passive solution, etc. These are the kind of things that you should be really aware of, that you can explain to distributors and showcase. It's important to showcase your funds in different scenarios. It's a bit like going to see a fashion stylist. You might have a really nice shirt. How can you style that in different ways? How do you make that shirt or that fund versatile? Because you don't want to be pigeonholed. You don't want to be to think. You don't want to be pigeonholed as a fund that can only work in specific scenarios. Show them how it can work across a whole range of stuff. And I suppose the second big do as well is, especially if you're a fund manager of smaller funds, is really consider building a segregated mandate proposition. I think that's a really important thing. Yes, you've launched your funds, but there are providers out there who, distributors who want, maybe want you to tweak it, or maybe they don't want to invest in your fund because they're going to overwhelm the fund. They don't want to, and they can't invest more than 20% of it. So, consider offering a segregated mandate that replicates the same strategy and allows them to have a more bespoke product. That will mean stickier business, and it will also mean guaranteed funds, guaranteed flows into your strategies. And it also, allows you to build bespoke solutions and create opportunities for you to co-create with these distributors, because you can go to them and suggest portfolios and how things could work, and strategic partnerships across a range of solutions. In terms of the don'ts, there are, of course, lots of don'ts. We've already talked about marketing materials, translations, as I said, make it easy for the examiner to help you with with the marking, make it easy for them to give you lots of points. But I think that a key message is that don't rely on one or two blockbuster funds or strategies. If you have a lot of big business and or a big company, a big distributor, and it's all in one fund, don't sit back on your laurels. It's absolutely important that you diversify that. Distributors can easily switch out of your products, can easily switch away from your funds, which is why I talked about the segregated mandate situation, because that gives you stickier business, and you'll hang on to it for a bit longer. But it's really important that you do not that you broaden and diversify your panel of distributors as well as your funds. And if you are a one fund company, then it's important, I think, to diversify that, because if the market turns against you, you've got nowhere else to go. I'm going to give you a couple of examples, some really high profile examples of where that's gone wrong. Here are 3 case studies. So Aberdeen relied on its Asian and emerging market strategies. It grew very, very big on that business. But when emerging markets tanked and the money started to flow out, it really struggled for survival. Standard Life also, it relied heavily on its global absolute return strategies fund, the GARS product. Again, when the bottom fell out of absolute return markets, it struggled. What happened was they had to merge the two. So 2 sort of weak fund managers had to merge to build some additional profile. And we're a few years later, that's still not necessarily the most successful merger that we've seen. Those funds are still not doing particularly well. A really important and high profile case is Woodford. He thought his strategy was unassailable and he flew too close to the sun. We all know what happened there. And again, this Woodford is a primary example of how to get everything wrong, because they relied far too much on Woodford as the fund manager. There was not enough risk and governance, not enough. The processes were not robust enough. And the one thing they should have done when they were growing, where it's so fast, because Woodford is very similar to what Aberdeen did in the early days, when they were growing so fast, what they should have done was diversified their funds and brought in some new fund teams. They had the money, they should have brought some new teams and diversified the gene pool, if you like, and reduced the over-reliance on Neil Woodford to manage those products. So that's essentially where I am. Let me stop sharing that now. So if you've got questions, I think it's, you may have lots of questions. You may want to ask me about different scenarios. So Stuart, do you have any questions on what I've just shown?
I do, actually. I'm going to make you the host so you can one of the things that I've certainly found with fund managers that we've worked with is I guess not just the quality, but the quantity of marketing material. We've worked with managers that produce quarterly updates, which are 52 pages long. And you just sort of go, really? And then equally, you get others who produce one side of A4, which hardly sort of covers the subject. What, in your experience, where do you think is the happy medium, not just in the sense of the quantity, but also what the sort of aspects that need to cover? This, bearing in mind, these are people who are not necessarily investors; these are potential investors. There's a big difference, isn't there? I would have thought.
Yeah, there is a big. Do you know, I call this the Goldilocks thing, right? Because you don't want it to be too cold or too hot. It's got to be just right, and that. I think the big mistake that a lot of companies make is they sort of produce these reports. They might have lots of funds. They put them all into one thing, and they pack them all off and send them off, and they think that's it. But you have to put as much focus on your marketing materials and your reporting as you do as the actual fund. Every bit of the process. If you think about the value chain, right? To me, it's about 10 steps long. Performance is just the very first bit of it. So you really do need to sit down and look at the marketing materials. What kind of language are you using? Is it, overly, technical? Can you get rid of a lot of it? Because I think what a lot of companies do is they let their compliance departments go mad on their reports, because they think that's the right thing to do, and the compliance and all the legal people in the compliance department think that's the right thing to do, but that's the wrong thing to do. So you have to get rid of as much as possible. Just keep it sensible. Take out any of the really sort of the stupid over. There's far too many sort of disclaimers and things like that. Get rid of them all. Make sure you're actually explaining the fund and the report carefully. I think the other thing also as well is also to ask the distributors. Ask them, how do you want to receive this? Don't bombard them with emails. With 100 reports attached. If they invest in 100 funds, then maybe they'll be interested in them. But if they only invest in 2, don't send a blanket email and expect them to find the right 2 in among the 100. Again, it's that coming back to that whole thing. Make it easier for the examiner, make it easier for the distributor to work with you. So find out, do the bit of homework and find out if they want to receive them all, or if they only want to receive 2, and then send them what they want. If they only want to receive it every 3 months, then send it every 3 months. If they want to be able to go on your website and download it, then do that. But that's what I mean about making sure the infrastructure is in place to support them. I think we've got some questions.
A couple of questions there. See those? If you were to work with 3 to 5 platforms in the UK, which would they be? Do they cost the same?
Do the platforms cost the same as for the distributors? Yes, roughly. I mean, there's obviously some change. There's some interesting aspects happening in the UK platform market. So there's a lot of consolidation. And you also have some platforms that are vertically integrated. So the likes of, for example, True Potential or Quilter, etc. But ultimately, you need to be on all platforms, and the reason you need to be on all platforms is because advice firms or intermediaries or big investors, they work with model portfolios, and those models have to be everywhere. So if you've gone and sold your fund to a Bruin or a Brooks Macdonald, they're working on the assumption that that fund is going to be available everywhere, because what they don't want to do is go, right, we've got one model here for Transat, AJ Bell, and Aegon and Centric, but we're going to have to adjust the model portfolio over here because that fund's not available. Yeah. So I think, next question, how should a manager structure themselves to work on institutional opportunities in the UK? Yes, I mean, it's slightly out of my comfort zone a little bit, because I'm really retail wealth management. That's my my bag. I think, again, the whole thing about the reporting, you have to really professionalize. You know, you've got to assume that they're going to want a lot of support. They're going to want to know how your investments work. But if you are targeting the pension funds, yes, you need to talk to all the big pension gatekeepers, the Mercers and co.
I can help on it. Yes, it depends, as you might say, that the size of the pension fund is the issue there. Mercers and the others are still controlling that. But what we advise with managers that are coming into the UK, in particular the institutional space, is that target the second and third tier gatekeepers, so the smaller consultancy firms. They've got a much broader bandwidth and their pension funds are much smaller, so they're not governed by allocation size, because you've got a relatively small fund and you're going into the British Steel Pension Fund or BP Pension Fund, you're not going to get in because you're
too small. Yeah.
Too small, and they'll often want segregated mandates rather than the fund itself. So target the smaller consultants. I've got no further questions. I'm conscious of time. Unless there's any further questions, I just would like to say a big thank you to you, Bella. So we had a bit of a technical issue at the beginning, but I think
I'm sorry. I hope that was useful. It's difficult to sort of know how to kind of guess what your questions might be, but you know, if you do have any questions or anything occurs to you, just send your emails to Stuart, and he'll share them with me, and I'll happily answer them. So
thank you so much for today. Appreciate it, and we'll speak soon. So goodbye, everybody.
Great. Thank you very much, everyone.
You're gonna have to end it.
Oh, I've got to end it. Okay. Bye, everyone.
Okay.
Stuart's lovely, by the way.
Thank you. Pay you later.